This video is the first of two videos which talks about the mathematics involved in credit cards. This video is particularly going to be talking about the credit cards with interest-free period. So there are two types of credit cards. I'm sure there are many other types of credit cards, but we'll only be looking at two. The first one is a credit card that has no annual fee, so they don't charge you an amount per year for the benefit of having the credit card. They charge a slightly lower interest rate than the other kind of credit card, but you pay interest from the day that you purchase something. So as soon as you put something on your credit card, you buy something with your credit card, you start paying a daily interest from that day onwards. The second type is a credit card that has an annual fee. It could be $50, could be $100. They also have a slightly higher interest rate, but they advertise a certain number of days interest-free. And they usually use the dreaded words up to, and 55 is a very common number of days interest-free. It's this one that we're going to look at first. Let's talk about what they mean by up to 55 days interest-free. It sounds very appealing if you can use the bank's money for a period of time and not pay any interest. And for some people who are very good with money, it's a very good option because there has to be some benefit in using this sort of credit card since they have an annual fee and their interest rates are higher. But if you use it to your benefit, it's a very good idea. So let's have a think about what they mean by up to 55 days interest-free. Most banks send out a statement or send you a statement electronically on the last day of the month. And then in that statement, they say you have usually 25 days up to the 25th of the next month to clear their balance. If you do clear your balance by the 25th of that month, then you won't pay any interest on any of those purchases that you made in that month. So let's talk about what it means by the 55 days interest-free. Say we're talking about April. I'm going to choose April because it's got 30 days. And you purchase something on the 1st of April, April Fool's Day. You go out and you put something on your credit card. So you will get a bill for that purchase that you've made on the 1st of April. You'll get it on the last day of April, which is the 30th of April. And that bill, the statement, will state that you need to pay off that amount that you put on the 1st of April by the 25th of the next month, which is May. So that does strictly mean, because you purchased it on the 1st, you've got till the end of the month, 30 days, and another 25 days before you have to pay off that amount. So that does mean that you are, for that option that you're making, that purchase you're making on the 1st of the month, you are actually getting 55 days interest-free. But if you purchase on any other day of the month in April, you're going to get fewer than 55 days interest-free. If you purchase something on the 2nd, you're going to get 54 days interest-free. On the 3rd, 53 days, etc., etc., etc. So you really do need to be very, very aware because you do not want to be incurring that higher interest rate. So let's look at a question that has this 55 days interest-free. Here's a question. Matt has a credit card with an interest-free period of up to 55 days. The interest rate is then 17%. Interest rates for credit cards are often much more expensive than savings accounts and other loans. In September, his purchases were these purchases. Now, the questions that were asked about this particular question were, what interest does Matt pay if he pays the entire amount on the 25th of October? And the other question was, what will he have to pay if he pays on the 27th of October? So we need to keep in mind now what's actually happening. Now, these are all September purchases, so his statement is going to arrive or be sent to him on the last day of the month, which is the 30th of September. And on that bill, it will say, you have 25 days to clear all of these purchases that you made in September. So 25 days after the 30th of September is the 25th of October. And if Matt is a very smart man, the answer to this first question is that he will not pay any interest if he pays off his purchases on the 25th or before the 25th of October. So he will only have to pay back the things that the cost of the things that he purchased. And that is the smart way of using an interest-free period credit card. But what if he loses track of his payments and he doesn't pay until the 27th of October? This is a disaster. Let's look at the solution to this problem. I've set up a table to make it easy for us to see what we're doing. I've got all of the dates of the purchases and the amounts. This is directly from the previous page. Now I've got this column here. Now this column is days until he pays his bill. So he's paying his bill on the 27th of October. This is not days until the 25th of October, because that time has sailed on by. So this is days from when he purchased his shoes until he actually pays the bank back for the shoes. So the way that I've done this is I've said 7th of September until the end of the month, which is 30th of September, is 23 days. Then he pays the bill on the 27th of October. So 23 plus 27 is 50 days. And because he hasn't paid on the due date, he's paying 50 days worth of interest. He doesn't pay the 2 days that he's paying his bill late. He's paying all the way back to the purchase time. So 50 days. Using a simple interest formula, I'm well aware that probably banks don't use simple interest for this, but for our purposes, we're going to assume that it's simple interest. This is the calculation. The $40 is the cost of the shoes. That's our P. 17% is the annual interest rate. But he's not doing it for a whole year. He's doing it 50 days out of 365 days in the year. So he's paid 93 cents. He's charged 93 cents interest for those shoes that he bought. Similar thing for the repairs. 12th of September, how many days between the 12th of September and the 27th of October? From the 12th of September to the 30th of September is 18 days. 18 plus 27 is 45 days. Similar calculation, 45 out of 365. Similar all the way down. So here on that final column, I've totaled up all of the interest. This is how much it cost him for not being aware that his bill was due on the 25th of October. People with these kinds of credit cards need to be very, very well aware of when their bills are due. And ideally clear your credit card, because the interest rate is higher than a regular credit card. So you're going to be paying more for the benefit of having this 55 days interest-free if you don't happen to pay the bill on time. Here's the total for the purchases that he did. So the total amount that he would have to pay, I'm hoping I've got it written under here. I don't have it written under here. The total he'll have to pay to clear his bill on the 27th of October is $1,030 plus $20.94, so $1,050.94. So while a credit card with a 55 days interest free is a fabulous idea, if you do not keep track, you are not only paying a higher interest rate, you're also paying an annual fee for the benefit of having this card. So they're only really for people who are good at money. The second part of this video, second video, is going to be about credit cards that don't have an interest-free period.